All right, so the next one we're going to talk about is the IPO base. That's a very powerful pattern that we've noticed. It's something that has launched massive moves. Many of our model book stocks will start off this way. And it's the way here at the firm we like to buy IPOs. We don't go in there and buy them on the first day. Sometimes you can make money that way, but lots of times you can just lose as much, if not more. That's more gambling, and we like to base things off of probabilities, looking at what has happened in the past. So we don't like to buy the stock in the first few days that it comes public, even if you can get those shares from your underwriter, which sometimes in the best deals is going to be impossible to get enough shares on those really hot IPOs. And if you can get the shares, you probably don't want them. So what we're going to do is show you an intelligent way that you can get into an IPO. And this is the way we do it. And it really kind of started off a number of years ago when Google came public. We all knew about it. We were all aware that the IPO was coming out, and we weren't buying it yet. But then it came out. It had the Dutch offering at $85, ran right up, hit 113.48. Everyone was talking about it. But then it starts backing off for a few days, comes down to 98.94. And it was very normal action. Of course, if you bought it at 85, on this one, you would have made a ton of money, but we could show you hundreds of them where they just went straight down. So we're just looking for an intelligent way to get into this stock. And we were all trading this stock as it started going through 113.5, right in that range. We were aware that that's where you should be buying it, but at that point, we didn't really have a base structure that we were using. Some of us were looking at it as a high tide flag, at least in that theme where you have this rapid advance as your flagpole, which came public at 85, runs up to 113. That's not our ideal 100% move, but that was the concept that we were kind of looking at, and it holds in tight and moves higher. And of course, we all know what happened with Google. It was a huge move, big institutional quality name, and something that everyone can understand because everyone uses Google. So this is really what the IPO base came from, was studying this and saying, okay, we know that Google happened, we were able to capitalize on it, and we want to make sure that we get it the next time. So we went back and we studied all of the IPOs. We looked at everything. One thing we found out is when you study everything, you'll notice that a lot of things don't work. So you want to kind of sift through and see what's different. Well, some of the things we noticed is the higher price stocks tended to do better, but that wasn't foolproof. Stocks with a strong story and fundamentals, they tended to do better. But really, it was looking at lots of factors in there. What was the general market doing? Typically, when the general market is strong, that's when your good IPOs are coming out. The story has to be intact, and you want to look for some good action. So that's what we're going to talk about now, is what is good in normal action. Well, typically this IPO base will start forming within about the first 5 weeks from the time that it goes public. So you're going to be watching right away. Now you can see this one formed in the first 3 days, comes public, runs up for 3 days. That now becomes our area of resistance. Once it hits 113.48 and backs away, we know that that's kind of the line in the sand. It wasn't able to go through, and we want to see how does it handle itself. Can it even get back above that before we even consider buying it? So it starts backing away. And you'll notice we put the depth in there. It comes down 13%. That's very normal. Some of these will come in right around 10% or so. Some of the more volatile ones will be around 20, even up to 25% deep. Back in the late 90s, I remember eBay had a chart that looked very similar to this, but it was really deep. It was over 50%. And that was in a unique and unusual time frames. But in general, most of these are going to fall less than 20%. And again, that high, that 113.48, that'll happen in the first 5 weeks that it's trading in most cases. And so it hits that area, and now we're seeing how it's handling itself. You want to start studying the volume action, the price action. It gives you a chance to read up on the story, really know what you're dealing with. Is this stock from a really strong underwriter, or is it kind of one of the lower quality ones that don't really get the great merchandise? We found that, at least lately, or for a while now, Morgan Stanley and Goldman Sachs tend to have kind of the best names. It's not always the case, but it puts the odds a little bit more in your favor. So the stock comes down, you're waiting for it to go through an area of resistance. As it goes through that 113.48 plus 10 cents, that's where you can start buying it. Now, this one wasn't ideal on that breakout day. It backed away. But if you're dealing with something like this, you're going to give it a little bit more room. You're not going to sell it just because it backs away and you can't go through there. You'd be buying it on that day, waiting to see what happens. And within 2 days, the stock started to launch and had a very big move. Now, in the volume characteristics, as the stock goes through the pivot of an IPO base, they're a little bit trickier. The volume rate that we would normally look at, that's just our average volume that we'd have over the last 50 days. Well, this stock hasn't even traded 50 days. So you really want to look at it in relationship to how it's been trading and kind of exclude the first day or two of trading. The first day or two of trading of an IPO is always going to be an enormous amount of volume. That's just the reality of when the stock comes public. Lots of people are flipping the stock. It's in everyone's eyes. So it's going to take a little bit more work. You want to see that pickup in volume relative to how the stock has been trading, but that volume rate will throw you off since we don't have 50 days of trading to base it off of. So again, this was Google, had an enormous run, and this is really the model stock of all the IPO bases. And when you see something that looks just like this, study it, and you want to be on top of it. The next IPO base we're going to talk about is Concho Resources, CXO, back in 2007. This one went public and kind of gave you a little false entry before it really started its move. So let's take a look at that. This is something that's very typical. We see it in a lot of our IPO bases. So your first day it comes public, you get that wide spread, and then it kind of backs off for a few days. So we've got a little over a week that it's trading, and then it goes through the high of that first day. That would throw you off. Most times our sideways action will be about 10 days or longer. I've seen a few come in at 9, 1 or 2 at 8 days, but typically we want it to be 10 days or longer sideways. So that was a little bit early on that first time it tried to go up there and backed away. So if you did jump on that, you'd probably be selling it later in that day. It just was a little bit too early to be buying it. Now you're just going to sit back and wait. There's no reason to trade it, no reason to try to get in a little bit early, the $13 range or in the low 13s. It's just not worth the risk reward because I've seen many of these fizzle. They just go public, they go sideways for a few weeks, and then they just roll over, and they can be very deadly. So we don't want to participate until the stock is able to go through that 1349. So after the stock went sideways for a couple of weeks, it powers through that 1349. Look how different it is on this pivot versus its first attempted pivot. When it first went up and hit that 1349, it immediately backed away, closing down for the day. This time, it's different. It went from almost the lows of that area, that 8% deep base, all the way up through that 1349, doesn't stop, keeps going, closing almost at the highs of the day with a big pickup in volume from your prior week. That's ideal. That's where you want to start buying the stock. And then again, we always buy stocks in 3 chunks. We buy a first chunk, we buy 50% of it as it's going through the pivot. If it goes up a couple percent, we buy another 30%. And then we follow on with our last 20 as it moves higher from there. So in the first couple of days, you would have your full position in the stock. And look at that nice move that it ended up having, this enormous move in a relatively short period of time. And that was a very successful base back in 2007. All right, our last IPO base is going to be Michael Kors. This is a more recent one, something that many of you have probably traded or at least bought their clothing and accessories. And so it's a name like the Google that we talked about. It's something you can relate to. You can go into the stores, touch and feel the merchandise. It always gives you an advantage to be able to understand what the company does, what they're selling, and it gives you a little bit more confidence to sit through some wiggles and wobbles that all stocks are going to have. So this one is a little unique. That's why we wanted to share it with you. Most of the time with the other stocks like the Google and the CXO that we just went over, you go public and you almost immediately start going sideways or down, creating your IPO base. This one, you went public, and within 3 days, you're powering into new highs. Now, you're not going to be buying the stock at that point. Even though it ended up working out, it wasn't enough sideways action to really form an area of resistance. So you kind of want to just wait at that point, let it hit some area of resistance, and then sit back and watch the stock. So the stock moves up, hits the 2758, and starts kind of going sideways a little bit, and then it has a nice shakeout. This is ideal. This is what you want to have happen because The people in the stock have not been tested yet. The people who bought the shares from the underwriter at $20, the stock has done nothing but go up. The people who have bought the shares in the aftermarket, they've made money on it. So no one is shaken out of the stock at this point. And that's what you want to have. You either want people to be worn out or you want them to be scared out. So at this point, it starts coming down. You have a couple bad days, getting rid of some of the weak shareholders. You can see that kind of nice shakeout and closes mid-range and then tightens up for a few days. Ideal type of action. And you're just waiting for it to go through that 27.58. And it happens with a nice little gap up. It's not a huge gap, but any gaps on the upside are positive, especially on a pivot. So as it goes through 27.58, of course, you add your 10 cents on there to make sure it really gets through there. You start buying this stock. And notice that volume. That's your highest volume that you've had in several weeks. That's the type of action you want to see. Very powerful move. Ended up having a really nice advance after this, and a lot of people were able to make a ton of money in this stock. So this was a great example, more recent one, Michael Kors, back in January of 2012. All right, so one of the things that we should discuss about IPOs is the data. The data is only as good as the history that you have. So many of the things that we like to look at, such as relative strength number, that's shortened. A relative strength number is something that we do over a year period of time. Well, if a stock has only been public for a couple of weeks, that thing is going to be skewed. Now, we've adjusted for it, but you want to take it with a grain of salt. Same thing with the relative strength line. It's over a short period of time. You can't draw the same conclusions. Of course, we'd like to see it moving higher and higher as the stock goes through a pivot area, but you're going to pay a little bit less attention to things like a relative strength number and a relative strength line as the stock is forming an IPO base. Same thing will happen with many other things, such as an accumulation distribution. There's just not enough time, not enough history there. And it's the same thing on the fundamental side. So those three things were on the technical side of things. So that was the relative strength number, the relative strength line, and the accumulation distribution. On the fundamental side, many of the companies won't provide all quarterly data. They will just provide in their SEC filings when they go public. They'll just give you a full year, or maybe 6 months or 9 months. So analysts, as well as our company, will just have to take that figure and just divide it by 3 if they give you 9 months worth of information. And you have to wait as the company starts having their regular quarterly EPS reports to kind of see how that true breakdown was. So when you're looking at the fundamentals as well as the technical ratings and numbers, you want to start realizing that all the information isn't there. That's another risk that you're taking. It's not the same thing as trading a stock that has been around for a year or more, where all the information is complete. The company is going public, you don't have a lot of history, and it does skew things. So keep that in mind when you're looking at anything, especially, for example, the relative strength line on Kors. It looks really good, but if it didn't look this good, almost going into new high ground as it goes through that 27.58, I'd still be buying that stock, just keeping in context there's not as much history.